Hello and welcome to Trust and Estates Virtual Forums, Planning for the Future, produced by Trust and Estates and wealthmanagement.com. Today's session is Ethics and Charitable Giving, and it's sponsored by Foundation Source. I'm Susan Lipp, Editor-in-Chief of Trust and Estates, and I'll be your moderator today. In a moment, I'll be turning things over to our speakers, but first let me explain how you can get the most out of this event. To improve your viewing and listening experience, you can move your webcast windows around by dragging on the title bar or resize them by clicking on their lower right corner. At the bottom of your screen, you'll find multiple application widgets. By clicking on these buttons, you can open and close widgets on your screen. A copy of the slides is available for download in the Resource List widget. Also located in the Resource List widget are instructions for continuing education credits. Please note that this webcast has been accepted for 1 CE credit hour towards the AEP designation program. The live broadcast of this event has been approved for 1 CFP Board CE credit hour. Investments in Wealth Institute has accepted this program for 1 hour of CE credit towards the CIMA, CPWA, CIMC, and RMA certifications. Instructions for credit submittal are available in the Resource List widget. For those attorneys in the audience getting a continuing legal education credit, please listen for a code word that will be stated at some point during the webinar. To get your credit, you'll need to put that code word into the survey that appears at the end of the webinar. You must also include your bar number and state of practice to receive the CLE credit. You can open the survey anytime by clicking on the survey widget on your screen. Again, please note that the CLE credit pertains only to attorneys. Please be aware that today's session is being recorded and will be available for on-demand viewing following the event. Now let me introduce today's speakers. We have Heather Rhodes and Conrad Teitel, who are principals in the Cummings and Lockwood law firm. They both lead the firm's National Charitable Planning Group and are members of the firm's Private Clients Group. Heather is the chairman of the firm's Private Clients Group in all 6 offices, and Conrad has lectured in all 50 states in over 1,000 lecture appearances. Joining Conrad and Heather is Jeffrey Haskell, who is Chief Legal Officer of Foundation Source. You can find more information about today's speakers by clicking on the speaker bio widget at the bottom of your screen. So with that, let's get started. And Jeff, I will turn the floor over to you.
Thank you so much. Well, thank you again, everyone, for having us and me here to join you for this panel discussion. We're going to talk about ethics and charitable giving, which, when you think about it, is rooted in special rules that govern private foundations and their managers. As a preliminary step, let's spend a minute understanding why we have these rules, because I often find that it's much easier to understand rules if you understand the reason for them. Typically, a private foundation's funding comes from private sources, such as an individual, a family, or a business. That being the case, a foundation isn't accountable to the general public in quite the same way that a public charity is. As a result, Congress felt it necessary to step in and address certain perceived abuses that were aired in congressional hearings back in the 1970s. The rules that we have today were targeted at curing those particular perceived abuses. Let's start with the self-dealing rules, which govern transactions between the foundation's insiders, known as Disqualified Persons, or DPs, and the respective foundations. I'll probably say insiders because Disqualified Persons is a mouthful, but you'll know what I mean. So here we have a list of the most common type of transactions with disqualified persons that constitute self-dealing. Notably, the self-dealing rules prohibit even those transactions that would be beneficial to a foundation, such as a disqualified person's sale of property to a foundation at a below market or even a sweetheart price. In addition to knowing the types of transactions that could result in a violation, it's also important to know the exceptions to the rule so that you're not unnecessarily limiting yourself or the foundation out of ignorance. Now, if you look at this loan, you see the very common things that like you would expect to see, like reimbursement of reasonable expenses. Again, loan of funds to the foundation at no interest, but never in the other direction. Reasonable compensation. But again, no exception for sales or exchanges at all, even if the deal's terms favor the private foundation. Because the self-dealing rules apply only to transactions with disqualified persons, really, if you think about it, the crux of the matter is to understand who and what is an insider, a disqualified person. After all, if you're not an insider, you can't be subject to self-dealing penalties. Aside from those actually serving on the foundation, such as the foundation's officers, directors, and trustees, substantial contributors to the foundation, businesses in which insiders have a significant ownership stake, and certain family members of all those earlier insiders I mentioned are likewise considered to be insiders or, again, disqualified persons in their own right. As an aside, the term family members includes parents and grandparents, children and grandchildren, and the spouses of disqualified persons, but the term excludes siblings and more distant relatives like nieces, nephews, aunts, and uncle. I'll just pause for a second and know that, and acknowledge that may confuse folks because the public charities have a set of rules that are very similar to a private foundation's, and under their rules for public charities, they also have a term disqualified person, and under their definition of that term, it does include siblings. But again, we're in private foundation land, and in foundation land, it excludes siblings. Anyway, that said, remember that a foundation's returns are open to public inspection, and a foundation would be wise, certainly, to consider the optics of engaging in a transaction with a family member that may be technically permissible, but could be viewed negatively or unethical, perhaps. If you're unsure, just remember the golden rule, which is the smell test never fails. But I always fall back to my go-to is my mother's line, which was, if you have to ask, the answer is no. So anyway, if we continue on, I think it's helpful also to understand what the stakes are for engaging in self-dealing. So I have a chart like this for the other types of violations that we're going to touch on this morning. So let me take a moment to explain how these charts are set up. The charts show which party is subject to a penalty, the foundation, the self-dealer, or the foundation manager, which means someone who has the power or responsibilities of the foundation officer, director, or trustee, whether or not they have that title. As a threshold matter, a violation leads to a first-year penalty and a requirement that the foundation do something to correct the violation. In some cases, that may mean unwinding a transaction, returning interest or rent paid, vacating rental space, or taking some other action. If a violation isn't corrected, especially after the IRS has notified the foundation that it must take corrective action, a very severe second-tier penalty can apply. First-tier taxes often apply to the self-dealer or the foundation when applicable, because the penalty can apply whether or not the self-dealer or the foundation did something wrong knowingly or innocently. The self-dealing penalty is unique because the foundation itself will never owe a penalty, actually. Rather, only the self-dealers are subject to the self-dealing penalties. And when a self-dealing violation occurs, both the foundation and the insider must file penalty returns to report the transaction and calculate the penalty due. The penalty is 10% of the amount involved, the amount of which would vary depending on the type of self-dealing transaction. For example, with a loan, the amount involved is the interest, not the principal amount of the loan. But with the sale, the amount involved would be the greater of the amount paid or the value of the item sold. Now, a business person might think that it may be worth the freight of a 10% penalty to go through with an otherwise forbidden transaction. But such a decision will be disastrous because the IRS will not relent. It will continue reassessing the penalty year after year until corrective action is finally taken. And ultimately, if the insider fails to take corrective action, the IRS can impose a second-year penalty or double the amount involved and ultimately even close down the foundation. Finally, unlike the penalties for the other type of violations that we'll be discussing, The IRS is unable to forgive a self-dealing penalty, even if there's reasonable cause, because the IRS simply lacks the statutory authority to do so. One of the abuses that Congress was trying to cure when it enacted these rules back in the 1970s was the so-called parking of private foundation assets, where contributions were made to the foundation. The donors had the advantage of immediate charitable deductions, but the contributed funds languished in the foundation's coffers without doing any good. To address this, Congress imposed a minimum 5% annual minimum distribution requirement that can be satisfied with grants and with certain qualifying expenses. Except for expenses relating to a foundation's investment assets like bank charges and investment advisory fees, many other overhead expenses like legal, accounting, or philanthropic consulting fees will in fact count towards satisfying this minimum distribution requirement. Fortunately, if a foundation grants more than is strictly required, any overage or excess granting can be applied to satisfy a future year's distribution requirement. And note that when one non-operating or grant-making foundation makes a grant to another non-operating foundation, only one of the foundations can count those grants towards meeting its annual payout requirement. And if we didn't have that rule, two foundations or more could simply pass the same grant funds back and forth to one another indefinitely and satisfy the respective payout requirements that way. Now note here that there's a 30% penalty, pretty steep, payable by the foundation on any shortfall, but there are no manager level penalties. As with several of the other foundation compliance penalties, this penalty too will be reassessed each year indefinitely until the violation has been corrected by making up the shortfall. Further, if not timely corrected, the penalty can increase to 100% of the shortfall. And the last statutory requirement we're going to talk about here, rule, is taxable expenditures before we jump into the case studies. The general rule here is that all foundation expenditures must be made for charitable purposes. This is a key importance. However, some types of expenditures are prohibited by congressional fiat, such as those involving lobbying, electioneering, and voter registration drives. That said, there may be a fine line between permissible activities and those that are flatly prohibited, like the difference between permissible advocacy on the one hand and prohibited lobbying on the other. While a foundation can freely make grants to charities classified by the IRS as public charities without any special oversight, grants made to other types of organizations generally are permissible only if certain procedures are followed. For example, grants made to domestic or foreign organizations that are not public charities can be made by following special procedures, collectively known as expenditure responsibility. These procedures generally entail due diligence, special grant letter terms, and reporting requirements. If the foundation wishes to make a grant to a foreign charity and NGO, an alternate approach known as equivalency determination may be viable as another option. But under this alternate approach, the foundation would attempt to determine if the foreign charity is the equivalent of a U.S. public charity. And likewise, although a foundation may make grants to individuals, certain types of grants require advance IRS approval of the overall grant program. Scholarships, fellowships, and travel study grant programs fall into this category, while hardship and disaster relief programs may be made without advance approval. So what are the stakes here? Again, the risk here is primarily on the foundation. And as all the other penalties, the penalty amount can increase dramatically if not timely corrected. Now over here, just a quick overview of the expenditure responsibility components. Now I think it's important to understand the theory behind this. So if you think about it, as I've said, when a foundation makes a grant to a U.S. public charity, generally expenditure responsibility is not required. Why? Because the charity itself is subject to federal tax laws governing 501c3 organizations. For instance, the requirement to operate exclusively for charitable purposes. But when you give to a grant recipient that's not a 501c3 organization, they're not subject to those strictures. So they're not subject to those altruistic or charitable tax rules. I'd say that one of the goals of expenditure responsibility then is to subject the recipient to the essence of these altruistic charitable rules by contract law, by requiring that there be a written contractual agreement. And aside from requiring that the grantee report on its use of the grant funds, the regulations require the grant letter agreement to contain special terms ensuring that the grant funds will be used only for a specific charitable purpose or return. Now, finally, let's turn to a few case studies. So in number one, you have the foundation's board members living in several different states, and they decide to have their annual board meeting at a location that's convenient for all of them, an all-inclusive resort in Mexico. A few board members want to bring their grade school-age children along because they wish to instill a sense of philanthropy in them at a young age, training them to assume their future roles as board members. The board members want the foundation to cover the cost of transportation and lodging for the board members and their families. Are there any problems with having the foundation pay any of the above expenses in connection with the board meeting? And what if all the individuals going to Mexico were instead staying at a remote village to help build huts for locals in a disadvantaged area? Well, let's take the first bullet first. So I think when many people lose sight of it, it's funny because I have many foundation clients that are very successful in their business lives. They run multinational corporations, but suddenly all their business sense, they don't think to bring it to bear when they're talking about or thinking about their foundation. So number one, numero uno, is to consider the necessity of travel. Determining the reasonableness and necessity of travel expenses, foundation should probably adopt a policy at the board level, requiring the foundation to consider the ways in which the foundation will benefit from the travel and weigh those benefits against the anticipated costs of the travel. Again, think of it this way. If this were, I say this to my clients all the time, if this were a for-profit business and you were the president of that company and that company's priority was on maximizing profit and value, would that be a smart business decision to take to have the company fly people from all over to Mexico where there's no particular locus or nexus or connection at all to Mexico? And I'd also ask, what value is there in having the foundation pay for the grade school-age children to come along? What can they meaningfully contribute to the foundation? It's unclear that they can contribute anything. So again, necessity, business judgment, it doesn't seem to make a whole lot of sense here. What if the children were older? Well, I don't know. Maybe if there was like a junior board, this is a very, very gray area, but in my experience, maybe towards the end of high school, college, you have people actually able to make meaningful contributions strategically and tactically to a foundation at the board level. It's extremely questionable whether or not it makes any sense for children at a young age to make a contribution. And I would also suggest that it's really not the foundation's job to instill philanthropic values in children. It's the job, presumably, of the parents to do that. So the parents could, fly the kids, by all means, have them come to the board meeting. But I think this is more of a personal expense than a legitimate foundation expense. That's my take on this. What would happen if instead of a board meeting, they wanted to fly the family to some remote area in an underdeveloped country and maybe build huts with everyone? So would that be better? Assuming that aligns with the foundation's mission? Even then, it's not so obvious to me that makes sense either, because the cost of flying a whole family, including kids, over to an underdeveloped country so they could build houses, for the cost of the airfare and lodging and transportation and everything else that's involved, they could probably build, 100 times as many huts and buildings, but for the travel expenses. Again, think of it as a business decision. Is it a smart business decision to have the foundation send people thousands of miles, especially like if they don't even have any specific skills in construction? By contrast, one year I had a foundation that actually had a veterinarian that flew over to a country in Africa where they had a game preserve, and he wanted to go in and provide dental care to the rhinos on the range, and that actually made sense because he had that expertise. He could actually do it, and apparently they didn't have that expertise locally. So anyway, it's a very nuanced kind of situation. Let me move on to the next slide. So here a foundation makes a grant to a museum and receives free ski lift tickets as a thank you from the charity. The foundation's vice president performed a great deal of due diligence on the museum prior to recommending the grant to the foundation's board. So the board's chair told the vice president to go ahead, use the tickets on his family's upcoming ski trip as a token of the board's appreciation for his hard work. So would it be okay for the vice president to use the tickets in this manner, which again does nothing for the foundation in terms of advancing the foundation's mission purpose at all? So if this smells bad, that's because I think it is bad, and it is bad. And the problem here is that I would regard the ski lift tickets as a foundation asset. And so to the extent that they could make good use of it, maybe by giving it to like the Make-A-Wish Foundation, or to give it to people, or maybe putting up for auction and using the proceeds to give to a charity. I see this as a problem unless it's part of a compensation package. So I guess conceivably, if the president isn't otherwise compensated, he puts in a lot of hours, and the board thinks that this is considering the responsibilities, commitments, hours worked, and all the other job responsibilities. This is reasonable compensation, and approaching reasonable compensation. I suppose that would be okay if it's income or reported as compensation to the president, then I suppose it would be okay, assuming that it is reasonable. Now, it would be another story, for example, if the foundation were to subsidize, say, an opera at the Met, or Avery Fisher Hall, or whatever. And in a case like that, having the foundation attend opening night or appear occasionally to audit the fruits of the foundation's grant to see whether or not the money was well spent, whether or not they wish to maybe subsidize future opera productions, whatever, that could make sense. But again, it has to align with and further the foundation's mission, have the foundation purpose to it, not a personal one. Let me go on to the next one. And by the way, just 1 second, I'm going to flip back here. The problem here is that if the foundation were to pay, I should have said this, the foundation were to pay an expense that's not necessary, it's not reasonable, it's not at all reasonable. Not only could that be self-dealing, it could also be a taxable expenditure, because paying for things that are not charitable and don't advance the foundation's mission could subject the foundation to a double whammy, as it were, taxable expenditure and self-dealing. You could have both in one case. Here, a non-operating foundation is expecting a grant from another non-operating foundation, and we said that those are generally grant-making foundations, but the grantor foundation has never mentioned anything about expenditure responsibility. In fact, the grantor foundation tells the grantee that it will be dropping the check in the mail tomorrow. Now, does the grantee foundation have an obligation to let the grantor know that it needs to exercise expenditure responsibility to avoid a 20% penalty? I mean, it's no joke. It's $1 million grant. That's a $200,000 penalty. Even though doing so would subject the foundation as a grantee to burdensome reporting and other obligations. Let me just step in and say that even though the foundation is itself a 501c3, because it's not a public charity, expenditure responsibility is still required, just to clarify that point. So look, here, there's no rule that says they have to do it, and if in fact there is the penalty would be on the grantor, not the grantee. Either way, no matter what happens, the foundation has no penalty. But obviously, the right thing to do here, the moral, the ethical thing to do, is to let a foundation know that, hey, if you've never done this before, you have an expenditure responsibility requirement. Because it would be very, very sad to have that grantor foundation take $200,000 that could have, if it's $1 million grant, that could have been deployed for charitable purposes and have to pay that penalty instead to the IRS. That would be a shameful thing. And what about the obligation to clarify which one of them should be able to count the grant towards meeting its 5% payout requirement? Because as you'll recall, only one of the foundations in a case like this can count it. In theory, if the foundation that receives the grant were to remain silent, it could spend down those grant funds and count it towards its own 5% payout requirement. But again, the right thing to do is to let the grantor know, hey, only one of us can count this towards our 5% payout requirement. It may be the case that the grantor doesn't need it. Maybe the grantor already made its 5% payout requirement. Maybe it's already made commitments, for other grants that's going to make that it'll handily make it and doesn't need it. But again, the right thing to do is to let the grantor know not only that they have to do expenditure responsibility, but only one of them can count it. And is it okay if I count it, or do you need to count it yourself? Let's do one more. The president of the foundation has 5 adult children and wants them to be involved in running the foundation by serving as program officers to oversee the foundation's granting activities. The foundation has $1 million in assets, pretty small, and an annual granting budget of about $50,000 per year, which is 5% of $1 million, which it typically spreads across 5 grants. In an effort to remain in compliance with the self-dealing rules, the foundation references several relevant foundation compensation surveys to arrive at the comp she wishes to pay each of them based on their experience and education. Is this problematic? Okay, so again, just like the travel has to be necessary, you can't just hire someone that you don't need the services of. No for-profit business would stay in business long if it went around hiring people that it didn't, and paying them salaries that for services that it didn't need. So again, assuming that the services are necessary, can you pay them a salary? So, I think everyone is probably saying, well, duh, no. But actually, it's not so clear to me that the answer is a solid no. I think that maybe something fair could be worked out to the extent the foundation really, could use or benefit from their services, always assuming that's true. What if they were to pay them on an hourly basis? They come up with a reasonable hourly rate. And if, the whole year means they're only spending 10 hours or 15 hours doing due diligence, then that's all they get paid. It doesn't, all because someone is paid compensation doesn't mean that they're paid an annual salary. You can have a situation where they're accounting for their hours and you're paying them on an hourly basis. So assuming it's necessary, helpful to the foundation, they're qualified, the hourly rate is relative to what other foundations would pay people performing like services with like experience, something like an hourly arrangement might be perfectly reasonable. Okay, well then I'm going to turn it over to the folks at T&E for their password that I think they need for CLE. Thank you.
Yes, thanks, Jeffrey. Yes, the password for attorneys in the audience is donor, DONOR. So if you want to get a CLE credit and you're an attorney, be sure to put the word donor in the survey that appears at the end of the webinar. And with that, I'm going to turn things over to Conrad and Heather.
Jeffrey, you covered more in a half hour than most people cover in half a day. Sometimes I'm at a dinner party or a cocktail party and people don't have a lot of time and they say, can you summarize what a private foundation is quickly? And I say, oh yes, a private foundation is a large body of money surrounded by those who want some. We all know that for ethics in life and in the professions, not to lie, cheat, or steal. But one of the things that we're going to talk about, Heather and I will talk about, will be knowing your stuff. It's not ethical if you don't know your stuff. And maybe this will sum up what we are going to say in our time.
In a law firm with a headache and a howling plaintive whine, sat a widower a grieving his decedent Clementine. Oh my darling, oh my darling, oh my darling Clementine, taxes lost and gone forever, dreadful planning Clementine. Dear, you might have left your dollars in a will that was designed for the marital deduction if you'd loved me Clementine. Oh my darling, oh my darling, oh my darling Clementine, taxes lost and gone forever, dreadful planning Clementine. If the trust had been acquitted, then the income would be mine to support and to maintain me, plus some principal Clementine. Oh my darling, oh my darling, oh my darling Clementine, taxes lost and gone forever, dreadful planning, Clementine, or a power of appointment over principal works fine, or a Q-dot if I came from Eastern Europe, Clementine. But I share this lousy trust, dear, with your adult children 9. Only hope is reformation, thanks a million, Clementine. Oh my darling, oh my darling, oh my darling Clementine, taxes lost and gone forever, dreadful planning, Clementine. Everybody. Oh my darling, oh my darling, oh my darling Clementine, lost and gone forever, dreadful planning, Clementine.
Well, you get the idea. Ethics. What are we going to talk about, Heather?
Well, I'm not going to sing it. I'm going to just explain that we're going to touch on some of the ethical rules in charitable gift planning. And in our materials, you'll see we included the canons of ethics for many of the professions that are involved in charitable gift planning, such as attorneys, CPAs, charitable development officers, trust officers, financial planners, CLUs, and even notaries. And as Conrad mentioned, one of the most important ethical threads that run through these guidelines that you'll note is competency. As Conrad said, know your stuff. You have to have the skill, the level of knowledge, the expertise to handle the task at hand. And it's important that you also respect confidentiality, and you'll see other ethical rules that we'll touch on. We actually have 13 hypoethicals, we call them, that are hypothetical situations. Some are real cases, some are fictional. We won't be able to cover all of them today. We'll touch on a couple, read one, summarize some others. But before we jump in, Conrad, what are your credentials to be teaching ethics anyway?
Well, many years ago at Columbia Law School, I took a required course in legal ethics, and here are my credentials. It's very, very important to have a qualified curriculum and a qualified professor. The professor at Columbia Law School, I'm not making this up, you can look it up, Professor Cheatham. And the textbook we used was Drinker on Legal Ethics, and you could look that up also. Drinker was the Drinker of the law firm, the Drinker law firm. They've Drinker Biddle, I think they've merged recently. So with Cheatham and Drinker, how could I not be qualified to lecture on ethics? It seems to me it's a natural.
All right, Conrad, let's jump into the first hypoethical. William Bill Abel is a triple threat. He's a lawyer, a CLU, and a financial planner. He is hardworking. Friends call him billable. A meat and potatoes guy, he enjoys watching sports on television and going to football games and NASCAR races. When he sees movies, not films, he likes them packed with action, car chases and shootings. He is divorced. Sarah Sensitive is a poet, unpublished. When she goes to the cinema, she sees films, subtitles of course. A vegetarian, she frequents health food stores and restaurants. When not taking long walks in the rain along the beach, she enjoys sitting in front of the fire. She has never married and lives off the comfortable inheritance from her father. Bill and Sarah met on disharmony.com, the dating site whose motto is opposites attract. Although Bill and Sarah have been dating for over 2 years, their relationship is still platonic. One day, warming up in front of the fire, after a long walk along the beach in the rain, Sarah told Bill of her deep love for the environment and her concerns about greenhouse gases. She planned on making a major gift to a new charity, Greenhouse Gases Be Gone. Bill questions whether she should make a sizable gift. You might need those assets for a rainy day, and he wasn't talking about a walk along the beach. Bill suggested that Sarah create a net income with makeup charitable remainder unit trust, or a NIMCRUT. That would pay her income for life with remainder to her charity. Sarah, but I really don't need any income. Bill, that is why I have suggested a net income with makeup trust. The trust will be funded with a deferred payment commercial annuity. No payments will be made to you. However, if you do need income, you can draw down on the annuity, not just for payments in the future, but to make up some or all deficits from past years. Sarah asked Bill to draft the trust and obtain the annuity. Biting on a celery stalk, he tells her that he will not charge her for drafting the trust, but he will get the annuity and receive the same commission that any other CLU would receive. Taking a puff on one of Bill's Camel cigarettes, she says that will be just fine. Bill drafts the trust and it is a beauty. It follows all of the provisions of the IRS's Safe Harbor Specimen Trust. Bill, after purchasing the annuity for the trust, contributes 10% of the commission without telling Sarah to Greenhouse Gases Be Gone. Conrad, what do we see here?
Well, I don't know how ethical it is for him to sell her an annuity. She was advised that he was going to do that and get a standard commission, but that doesn't sound quite proper to me. And lawyers have to be ethical all the time, and they should be trusted. Although, of course, if they want to get CLE credits for an ethics session, I don't know how much some states trust them because they need a certain code name, which I cannot mention again because that would be unethical. But let's forget about the annuity for the moment. Let's talk about the type of trust that she created, a net income with makeup trust. There are basically four types of trusts: standard child remainder trusts, net income with makeup child remainder trusts, net income with no makeup trusts, and also since the 1990s, the flip child remainder unit trust. If there's time later, I'll go into all of them, but let me now talk about, and there probably won't be time, but let me talk about the net income with makeup child remainder unit trust. It works this way. Trustee, you are to pay me the income, the fixed percentage. Generally, it has to be at least always has to be at least 5%. So pay me this fixed percentage times the fair market value or the actual income, whichever is lower. That trust goes on to say, in any year that the actual income exceeds that multiplied amount, you can make up deficits from earlier years. So that was put into the law way back in 1969 for the purpose of someone who had an asset that didn't necessarily earn income right away. And since there's a requirement, as this law was first drafted, that payment must be made every year, you couldn't fund that trust with closely held stock or real estate because there was no guarantee that it was going to earn income enough to make the payment by either earning enough income or being able to sell the asset. So the birth of the net income with makeup child remainder trust. But in this particular case, this trust is invested in a deferred payment commercial annuity. Basically, you can pull the trigger at any time and say, all right, we're going to pull down something from the deferred payment annuity, and you can make up the income. Well, there's another party involved in all of this, and that is the Internal Revenue Service. And the IRS said, this is a prohibited act of self-dealing because you can control when you will have income. That wasn't the intention of the Congress when it enacted the net income with makeup child remainder unit trust. So here's a case where it's crucial for the drafter to know her or his stuff. Heather, why don't you tell us about an actual case that took place in our office? Hypotheticals are nice, but how about the real thing?
Absolutely, and that was what hypoethical number 2 was modeled after. And in this case, the grantor or donor had created an estate plan that left assets to a major university at her passing to be used by the university as it chose. Ultimately, though, the donor was speaking with her advisor at the bank and was convinced by the advisor to change her estate plan to create a charitable remainder trust and then have the assets continue in trust for the major university in perpetuity. And unfortunately, what happened is those assets being held in trust in perpetuity would actually create a private foundation, and the assets would obviously be burdened by fees that were being paid to the bank, who was going to be trustee of this trust in perpetuity. So we actually were able, before bringing suit, to speak with the bank and involve major university and come up with a reformation so that the assets could actually pass as they'd originally intended to major university to be used without that kind of depletion of the fees and this perpetuity of a private foundation arrangement. So we were lucky to be in a state where we were able to do that reformation without proceeding with some substantive court action.
Heather, let me comment on being in a state where the state attorney general and the state laws encourage charitable giving, and they want to protect the charity. In the case that we had in our office, there would have been trustees' fees for ever. This way, it was invested in the endowment. Let me segue into an area where a mistake is made. This was a deliberate attempt by the trust officer to have fees for the bank in perpetuity. To segue into this, let me take you to a monastery, and a new recruit or new monk enters the monastery, and he is greeted by the abbot, and this new monk is only 20 years old, and he said, "Oh, I'm so happy to be here. What will I be doing here?" And the abbot said, "You are going to take over from Brother Theodore. Brother Theodore is now 92 years old, and he arrived at about your age, and for the entire time he has been here, other than sleeping, which he didn't do too much, and praying and eating, but most of the time he made copies of the rules of our order, and you are going to take over from him." What an honor that is. And they said, matter of fact, here's the last copy that he made. And the young monk said, "Well, I'm kind of uncomfortable looking at a copy. Could I see the original?" And, well, he was told, well, he never would make a mistake. Brother Theodore would never make a mistake. But if you're concerned about that, Brother Theodore, go down to the archives and get the original. Time goes by, and after 5.5 hours, he doesn't return. They decide they better go down and see what's happening to him. And there is Brother Theodore wailing. He's crying. And they said, "What's the problem?" And he said, the word is celebrate. So you have to be careful about Scrivener's errors. And in the tax law and the charitable area, if a court will say something is a Scrivener's error, it's not difficult in many states to get a court to reform something that should have been in there. And a Scrivener's error is not a typo, it's missing a major provision. And so if when a matter comes into your office, it's important to look at it immediately to see whether it is going to pass muster. And if it isn't, then you're going to want to go into court and get a Scrivener's error. But before you do that, call the drafter of this faulty document and say, we have a problem with this, and we certainly don't want to hold you responsible, but we represent the client, and even though you're a fellow lawyer, we have to represent our client. So a few things. We want you to help us patch this up. And one thing you can do right off the bat is notify your malpractice insurer and give us proof that let us see your policy so we know what your coverage is, and then give us proof of that you've actually notified the carrier. And also, we don't want to begin a lawsuit, so we want you to toll the statute of limitations. This is really important to always keep in mind, to try to find someone who is responsible for making the error. And the courts have been, IRS has been generous in finding a scrivener's error. In many cases, a scrivener's error wasn't a typo, it was just stupidity on the part of the drafts person. And it's your obligation to represent your client and not be concerned about other professionals. We're concerned about them, but I'm always reminded of the Daumier print, where you have a French lawyer and he's holding his arms, one arm around a widow and the other arm around an orphan. And the caption in French, but I'll translate it, is, "I am for the widow and the orphan, except when I am against the widow and the orphan." What are we going to talk about next, Heather?
Well, in the last few minutes we have, Conrad, I wanted to touch on hypoethical number 9, which again is a real life case, which is the Atkinson case.
Well, it's nice to talk about, you may have heard the song, "It's a Long Way to Certiorari." Well, the Atkinson case involves an individual who created a charitable remainder annuity trust in her 90s, and it provided income annuity payments to her for life. And then on her death, payments to her caretaker and then 3 relatives. And the trustee, a bank, missed paying 7 payments during her 7 quarterly payments during her life. We don't know whether she ever got the income tax charitable deduction, but entered the IRS and disallowed the estate tax charitable deduction. And large amounts were involved, and the charitable remainder organizations were marquee, well-known charities. The executor of the trust of the estate was the bank, the same bank that was the trustee that missed 7 payments. And the Internal Revenue Service said, this has all the so-called bells and whistles. It's beautifully drafted. We haven't come upon any instrument on the face of the earth that could have been better drafted than this. But you didn't follow the rules. And since this wasn't operated as a charitable remainder trust from its inception, there is no estate tax charitable deduction. And the service went on to say, there's another provision in the trust, and you had the perfect provision in that trust. You had a provision that's required in the governing instrument that says that at my death, when that trust was drawn, any beneficiary, if there's any estate tax attributable to that beneficiary's interest, that beneficiary has to either pay the estate tax or disclaim her or his interest. Well, there were, as I mentioned, 4 beneficiaries, the caregiver and 3 relatives. The 3 relatives said, "Oh no, we're not going to pay any estate tax. We disclaim our interest." The caregiver said, "Well, I'm going to make trouble if you don't pay me." And so they paid her. So here the taxpayer lost at the IRS, lost in the tax court, lost in the 11th Circuit, U.S. Circuit Court of Appeals for the 11th Circuit. And I said it was a long way to certiorari. And when they finally got to the Supreme Court, the Supreme Court said, "We deny certiorari." One of the problems in many states is that the remainder people, if they're civilians or charities don't always have information that a trust has been created. In this particular case, had the charities known about this, or had they chosen to do so, here the trustee and the executor were the same, so the trustee couldn't have maybe sued the itself. But if charities know about this, then they would have, depending upon state law, a cause of action against the people, because a couple of $1 million were lost because of losing the estate tax charitable deduction. Oh, parenthetically, have you noticed a lot of people, some people speak with punctuation, and the most common thing, of course, it quotes, quotes, I have worked this out. I can now do inside and outside quotes. I work on this for quite some time. So bottom line, cert was denied. What else are we going to talk about, Heather? We have some more time here.
We do have a little bit more time. I had mentioned notaries, Conrad, in the beginning of the program, and I know our materials do have some of the canons of ethics of notaries, but I think you have some specific notary story to tell.
Yeah, well, notaries go back to Roman times, and one of the things that we emphasize in our materials is it's important to know the ethics of your profession, but you have to know the requirements of other professions. We're not going to go into this now, but a very contentious area in the tax law now is the area of conservation easements. And there are cases now where appraisers are actually being sued for malpractice, and the government wants to indict some of them for overinflating values, grossly inflating values. So if you have a appraiser who says, how do you want this appraised? Do you want, one of our hypoethicals deal with works of art. Is this an appraisal for a gift to a family member or a gift to a charity? Of course, if there's a gift to a charity, the appraiser who asks that question frequently will say, oh, that's worth a lot. And if it's to a family member subject to gift or estate tax, isn't worth all that. So it's important to know the rules of, and IRS sometimes doesn't wish to battle with a donor's estate or during lifetime over the issue of fair market value. It will say at the outset, the appraisal is not good. It wasn't signed in the right place. The appraiser didn't have the proper qualifications. So it's important to know about the rules of others. During the pandemic, to get things notarized, you didn't, in some states, have to appear in front of the notary. The notary could have been outside the door, or you could have done that remotely. So it's important to know, because you can have the best instrument in creation, but if it's notarized and it's not properly notarized, you might as well not have had a wonderful agreement. And I mentioned that the Office of Notary Public goes back to Roman times. In recent times, maybe some of you haven't heard about this, but in when the SEALs, the Navy SEALs landed, they parachuted in, and they killed bin Laden. They had a notary there who took affidavits that it was actually bin Laden who was assassinated. These were notaries who also, two notaries actually came in, and they parachuted in, and they hit the ground stamping. And there's an elite group of notaries known as you heard of the Navy SEALs? Well, these were the notary SEALs. Now, I understand that we are to have some questions, and it is hoped answers. Let me segue into this by telling you about when Albert Einstein first came to this country, of course, he was well known for his relativity theory, but television didn't exist, and people had an idea what he looked like. They saw his photo in newspapers and magazines, and he was teaching at Princeton, and he embarked upon a lecture tour starting in Princeton and by car with a chauffeur. And the first stop was Columbia University. Then he went to MIT, and then a few other stops till he got to the University of Chicago, where he lectured, and then a few other stops on the way to California. And then the final lecture at MIT, Massachusetts, no, it wasn't at Caltech, it was MIT, it's back east. At Caltech, Einstein looked at his chauffeur and he said, "Did anyone ever tell you that we looked alike?" And the chauffeur said, "I get that all the time." And Einstein, of course, genius, but also had a great sense of humor and whimsy, said to the chauffeur, Do you think you could give my lecture?" And the chauffeur said, "Give it. I do it in my sleep." "Well, what about the question and answer session? How would you?" He said, "Same questions get asked all the time." So Einstein took off his jacket with the patches and he gave it to the chauffeur, and the chauffeur gave Einstein his jacket and the cap, and the chauffeur is up there lecturing. Einstein is in the back of the room dressed as the chauffeur, and the chauffeur is dynamite. He's better than Einstein. He makes eye contact with the audience. When he writes on the board, he writes faster, but it's legible. And he answers question after question after question. But then a question that had never been asked before is asked. The chauffeur, not missing a beat, looked at the back of the room and he said, "The answer to that is so simple that even my chauffeur can answer it." Well, now we have some questions, and Heather and my chauffeur is Jeff. Questions, please.
Okay. Well, first, Conrad, you've gotten a lot of compliments on your jokes, and so people seem to really appreciate that. Just wanted to mention it. And we have a question for Heather. Is it okay for a charity's board member who is an attorney to draft a will or other gift document for a donor? Does it make a difference if the attorney receives a fee or performs the work for free?
Thanks, Susan. And I do think one of the issues here is, who is the client, right? Is the client the donor in this example, or the charity? If the attorney is actually engaged by or working on behalf of the charity, then potentially that attorney could prepare, for example, a sample document for use by the donor to provide to the donor's counsel for review and possible, amendment or use. Now, we always tell, if we're working on behalf of a charity, we always tell the donor, obviously, to consult with his or her own counsel on that matter, that we clearly represent the charity's interest here, but want to facilitate the donor making, a contribution. So I think here we have to clarify who the client would be in this situation. And then if the attorney is working for the charity, then typically the charity would pay for that sample document. If the attorney is representing the donor and that was clearly spelled out, then, would the donor be paying a fee? Or then the question would it be, complimentary? So I think clearly the ethical rules there to navigate. The first one we want to focus on is who is the client in that situation. Thanks, Susan.
Heather, in the first hypoethical we had, the attorney was dating the client, and you emphasized the word platonic relationship. Does that make any difference?
I did emphasize platonic there, and it does make a difference. And actually, as many things, state law, it controls here. And there are some states that say that even a platonic relationship boyfriend, girlfriend is enough to prevent the attorney from representing his or her significant other. Other states, it has to be more of a sexual relationship before that line is drawn where the attorney can't engage in representation. But it definitely matters what relationship is between the two parties there.
All right, this one is for Jeffrey. Would it change things if, this is regarding the case study about a board meeting in Mexico. Would it change things if the children were graduating from high school instead of being in grade school?
Yeah, I think at that point, it might be more of a meaningful contribution that they might be making to the board. So, my experience going into college, that's where a lot of folks in the field may draw the line. Again, the foundation can't pay for their airfare or for their travel unless they're actually doing something, whether they're making a report or contributing in some meaningful way. Just to be an observer, I don't see that as working. But if they are going to be there and able to make a meaningful contribution, which I'm gauging maybe end of high school, sometime in college, and they have something to do, then yes, I think it would make a difference.
All right. Also, I noticed from some of the questions that there seems to be some issues finding the materials, Conrad and Heather's materials. So I'm going to have to look into that after this is over and get those materials out to the attendees. I'm not sure exactly what happened with that. So anyway, we have run out of time. And so I would, again, like to thank our speakers, Conrad Teitel, Heather Rhodes, and Jeffrey Haskell for an outstanding presentation. And I'd also like to thank Foundation Source for sponsoring today's forum. We'd like to invite you all to check out our other virtual forums taking place later today. You can click on the upcoming forums widget located on the bottom of your console. Once you leave the event, a short survey will pop up in your browser window, and we'd appreciate it if you would share your feedback on this event, as it helps us to provide you with content that's most interesting for you. On behalf of Trust and Estates and Wealth Management, have a great day.